Ever feel like your money just sits there, not doing much? You might have a savings account or a piggy bank, but it seems like your money is just idling away, not really growing or working for you. You work hard for it, but it doesn't seem to grow much on its own. You put in long hours, make sacrifices, and yet, when you look at your savings, the growth is minimal. It's frustrating, isn't it? What if you could make your money work as hard as you do? Imagine if every dollar you saved could be like a seed planted in fertile soil, growing and multiplying over time. That's where investing comes in. Investing is like giving your money a job, a purpose. It's about putting your money into vehicles that have the potential to grow and generate more wealth. And one of the best ways to get started is with mutual funds. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other securities. This essay will be your guide to understanding these powerful investment tools. Whether you're a beginner or have some experience, understanding mutual funds can be a game changer for your financial future. We'll cover what mutual funds are, the different types, and how they work. You'll learn about equity funds, bond funds, index funds, and more. Plus, we'll look at the benefits and risks involved so you can make informed decisions. Investing always comes with risks, but understanding them can help you manage and mitigate those risks, so you can make smart choices for your financial future. We'll discuss how to evaluate mutual funds, what to look for in a fund manager, and how to align your investments with your financial goals. Get ready to learn how to put your money to work and build wealth over time. Let's dive in. By the end of this essay, you'll have a solid understanding of mutual funds and how they can be a powerful tool in your investment strategy. So grab a cup of coffee, sit back, and let's embark on this financial journey together. Imagine a potluck dinner. Everyone brings a dish to share, creating a delicious and diverse spread. Mutual funds work similarly. They pool money from many investors, like everyone bringing dishes to our potluck. This large pool of money is then invested in a variety of assets like stocks and bonds, much like the different dishes at the potluck. Each investor owns a share of the fund, represented by shares, just like everyone gets to enjoy the combined meal. Just like our potluck offers various dishes, mutual funds come in different flavors to suit every taste. Equity funds invest primarily in stocks, offering higher potential returns but also higher risk. They're like the spicy dishes at our potluck. Bond funds focus on bonds, providing more stability and lower risk, similar to the milder options. Index funds track specific market indexes, aiming to match their performance like a buffet staple everyone enjoys. Balanced funds combine stocks and bonds for a mix of growth and stability, offering a balanced plate. Section 4. The inner workings of a mutual fund. Mutual funds are a popular investment vehicle that pool money from many investors to purchase a diversified portfolio of stocks, bonds, or other securities. Behind each mutual fund is a fund manager. This individual or team is responsible for making the day-to-day decisions about what assets to buy and sell within the fund. Think of them as the chef who selects the ingredients or assets and prepares the dishes, managing the fund. Just like a chef needs to balance flavors and textures, a fund manager needs to balance risk and return. They use their expertise to make investment decisions, aiming to achieve the fund's objective. This could be growth, income, or a combination of both. They analyze market trends, economic data, and company performance to make informed choices. When you invest in a mutual fund, you're buying shares of that fund. Each share represents a portion of the fund's holdings. This allows you to diversify your investments without needing a large amount of capital. The price of each share is determined by the fund's net asset value, or NAV, which is calculated at the end of each trading day. The NAV is the total value of the fund's assets minus its liabilities, divided by the number of shares outstanding. Keep in mind, there are costs involved. These costs can impact your overall returns, so it's important to understand them. Mutual funds charge fees for managing your money called expense ratios. These fees cover the cost of the fund manager's expertise, administrative expenses, and other operational costs. These are important to consider when comparing different funds. A higher expense ratio can eat into your returns, so look for funds with lower fees that still meet your investment goals. Before investing, it's crucial to read the mutual fund's prospectus. This document provides detailed information about the fund's investment objectives, strategies, risks, and fees. It helps you make an informed decision. Understanding your own risk tolerance is also key. Some funds are more aggressive, aiming for higher returns but with higher risk. Others are more conservative, focusing on preserving capital and providing steady income. Reviewing the fund's past performance can give you an idea of how it has managed in different market conditions. However, remember that past performance is not indicative of future results. Finally, consider your investment horizon. Mutual funds are generally best suited for long-term goals, such as retirement or education savings. By understanding the inner workings of mutual funds, you can make more informed investment decisions and work towards achieving your financial goals. Section 5. The upsides of mutual funds. Investing in mutual funds offers several advantages. These advantages make mutual funds a popular choice among both novice and experienced investors. First, they provide instant diversification. Remember the potluck analogy? Just like a potluck dinner where everyone brings a different dish, mutual funds pool money from many investors to buy a variety of assets. Instead of putting all your eggs in one basket by investing in a single stock, you're spreading your risk across multiple assets. This means that if one investment performs poorly, others in the fund may perform better, balancing out the overall risk. Second, you benefit from professional management. Mutual funds are managed by experienced financial professionals who have the expertise and resources to make informed investment decisions. You don't need to be a stock market expert to invest in mutual funds. The fund managers handle the research and investment decisions, saving you time and effort. This is particularly beneficial for those who may not have the time or knowledge to manage their own investments. The fund managers continuously monitor the market and adjust the fund's portfolio to align with the investment objectives. This active management can potentially lead to better returns compared to individual investing. Third, mutual funds are highly liquid, meaning you can easily buy and sell shares. Liquidity is an important feature because it provides flexibility and access to your money when you need it. This flexibility allows you to access your money when needed. Whether you need to withdraw funds for an emergency or take advantage of a new investment opportunity, mutual funds make it easy to do so. Finally, mutual funds are accessible to investors of all sizes. This inclusivity is one of the key reasons why mutual funds are so popular. You can start with a relatively small investment, making it easier to get started. This means that even if you don't have a lot of money to invest initially, you can still participate in the market and potentially grow your wealth over time. Additionally, mutual funds offer a variety of investment options to suit different financial goals and risk tolerances. Whether you're saving for retirement, a child's education, or simply looking to grow your wealth, there's likely a mutual fund that fits your needs. For those planning for retirement, mutual funds can be a key component of a diversified investment portfolio. They offer the potential for growth, while also providing income through dividends and interest. Mutual funds can also be a great way to teach younger generations about investing. By starting early, they can learn the importance of saving and the benefits of compound interest. Regularly reviewing your mutual fund performance is important to ensure that your investments are aligned with your financial goals. Many mutual funds provide detailed reports and updates, making it easy to stay informed. Consulting with a financial advisor can also help you make informed decisions about which mutual funds are best suited for your individual needs and circumstances. In summary, mutual funds offer a range of benefits including diversification, professional management, liquidity, and accessibility. These advantages make them an attractive option for investors looking to build a balanced and potentially profitable investment portfolio. Whether you're a seasoned investor or just starting out, mutual funds can provide a solid foundation for achieving your financial goals. Section 6. Risks to keep in mind. While mutual funds offer compelling benefits, it's crucial to understand the risks involved. Just like any investment, mutual funds are not risk-free. The biggest risk is market risk. The value of your investments can fluctuate depending on market conditions. When the market is down, so is your investment. Another risk is management risk. The fund manager's decisions might not always be successful, and their choices could negatively impact the fund's performance. Lastly, remember those expense ratios we talked about? While relatively small, they can eat into your returns over time.